Hey class. So before we move on to another example of how to do the math associated with this chapter, I wanted to take a few minutes to do like a brief lecture component so that we can all be on the same page before we attempt our next problem. So this is kind of where we left off when we were in class. The last slide, if you don't remember, was this one. So we were talking about investment rules, and we were talking about, if two different assets have the same expected return, then obviously we're going to choose the asset with the lowest expected risk. So in that first graph there, you'll notice that the expected return for assets A and B are the same, but the risk is different. There's more risk associated with B than there is with A. And so given the information that we have, we would choose asset A in that scenario. And then looking down at figure 8.5, we see the opposite. So we see two assets with the same level of risk, while one has a much higher expected return than the other. So in that case, since C and D have the same level of risk, we would then choose asset C because it has a higher expected return. And we also discussed how it is highly improbable that we would see this in real life. We haven't talked about this term much, but there's a term in finance called arbitration. And that is when, sorry, that's my dog. He is, probably see somebody out the front door. So moving along, but in finance, there are folks out there who try to exploit relationships like this by buying assets that are either under or overvalued and capitalizing on that until that overage or underage is brought back to equilibrium. And we haven't really dug into that level of finance just yet. But that is, I just wanted you to understand that that is the reason why it's highly improbable that you would ever see this in real life. It's because there's always folks out there that are going to exploit it. And by exploiting it, it basically eliminates that either overage or undervalue. So then we got to this slide and we talked about how this is really more along the lines of what we would see. So we might be looking at two separate assets, and while asset L has less risk, it also has less of a return expected in the near future. And while S has more risk, it also has a higher expected return. And so the question then becomes, which is the better investment to make? And we've talked about the risk to return relationship for every investor and how it really comes down to your level of risk tolerance. But there are some different measures that we can use to determine which one is riskier based on that return, right? And that's kind of what we started to do. We've been looking at total risk. We've been looking at how to calculate the expected return or the expected average return based on multiple scenarios with a given asset. And then we've started to look at how to calculate the standard deviation, which is a statistical term used to determine, how much variance is associated with that average, right? And so now that we understand how to do that for one stock, the question then becomes, how can we do it for multiple stocks in a portfolio? Because at the end of the day, I want a group of stocks, right? I don't want just one. Putting all of my money into one stock is a very dangerous thing to do, because then my investments rely on the performance of a single stock. Obviously, if we invest in multiple stocks, then the chances of all of them going up or down are less, and therefore I'm protected a little bit against fluctuations in the stock market. And that's really what this chapter boils down to. It boils down to the importance of diversification, which is the spreading of wealth over a variety of investment opportunities so as to eliminate some risk, okay? So basically what that means is that if we divide up our investments across relatively low correlated assets, companies, industries, and or countries, it is possible to considerably reduce our exposure to risk overall. So what does that mean? What does low correlated mean? So we talked about this in class as well. That means that maybe one stock's reaction to a bullish stock market might mean that it rises along with the market, but maybe another stock in my portfolio falls when one rises. And, you know, some beginners in finance might think, well, gosh, I wouldn't want any stock to fall. I want all my stocks to rise. Well, actually, that's not true. To be able to diversify away risk, we actually want stocks that are negatively correlated. And what that means is that while some will rise, others will fall, and the mean or the average of the returns that I get actually just results in a steady rise. And I did draw a few graphs on the whiteboard that kind of explained this. What we're really hoping for is just to have that steady, reliable rise. It's not going to give me the highest return possible, but it is going to give me one that I won't worry or fret about every night before I go to sleep. Okay, and so that's the reason why most financial managers are going to seek out diversification in their portfolios. So let's move on to the next slide here. This is, like, you know me, I love examples. So this gives a really good example. So earlier we looked at a single company. Here is an example of two. And so this is a portfolio comprised of two firms, because we just want to keep things simple right now. Now, in reality, most portfolios are going to have somewhere in the ballpark of 25 or more stocks, different companies in their portfolio. But for this example, just so that you can kind of grasp what's going on, we have just two. We have company Zig and company Zag, and our portfolio is weighted evenly, which means that we have 50% of our money tied up in Zig, and we have 50% of our money tied up in Zag. And so you'll notice that this is very similar to the table that we covered in lecture. In our first column, we have the state of the economy. So we have our three different expectations of the near future. In the second column, that's our guesswork, remember? So that would really, in reality, that would be the last step that we would take. But, they like to give it to you first. I'm not sure why. But it's our guesstimate as a financial analyst of the probability of an economic state in the near future. All right. And then our next two columns are going to be the expected returns based on looking backward. And you'll remember in a previous video, I drew like a timeline where we have our investor and he's standing at time zero, and he looked backward. He looked to the past, or she looked to the past, and she took note of what happened to company Zig's stock during a boom. She took note of what happened to company Zig stock during a steady incline. And she also took note of what happened to company Zig stock during a recession. And she or he also looked at the same variables for company Zag. And so what we have here is we have our expected returns giving different economic states. But what's very interesting is what the expected return is of both companies given an economic state. What do we note here, right? So there's a couple of different ways that we can calculate what you're seeing going on in that final column. You can either sorry, I needed to clear my throat. You can either calculate the weight of a given company and multiply it by the expected return in that company, and then add it to the weight of the second company multiplied by the expected return of the second company. Or you can find the independent returns for a given state, an economic state, right? And then you can take the weight and you can multiply of each company and multiply it by the returns given an economic state. Either way, you're going to come up to the same answer. And that's what this table is showing you, is that you can either do the math across by taking your economic state and multiplying it by the return of Zig. Say, for example, for the boom, you can say 0.2 times 0.25 plus 0.2 times 0.05, and then add or find the sum of the two products, and you will find it to be 0.15 for both companies given an economic boom. Or you can work your way down for each company. So you can say, okay, I'm just going to analyze the return of ZIG by itself. So zero point 0.2 times 0.25, 0.5 times 0.17, 0.3 times 0.05, add all them up and find the expected returns that way. But the really neat thing is that either way, you're going to get an expected return, in this case, of 15%. And how do we come to that? Because once we work our way either all the way across a row to the far right column or all the way down a column to the bottom row, what we then have to do is we then have to multiply each expected return for either each economic state or each company by 0.5. And where do we get 0.5 from? Well, it's a 50-50 portfolio. And remember, weights have to add up to be 100%. And so in this case, there's 50% of my income or my investment income in ZIG. So if my expected return for ZIG is 15%, then I have to multiply that 0.15 by 0.5 because only half of my money is there, right? And that's going to give me half of 0.15 or 0.075. And then same thing goes for ZAG. So I'm going to multiply my expected return for ZAG, right, by 0.5, also 50%. So 0.15 times 0.5, which is also 0.075. And so then when I have an expected return for each company, I add them together, and that gives me an expected return for the full portfolio of 15%. Now, this is really easy numbers, right? So the publishers of your book really chose some very simple numbers that add up very nicely. That will not be the case when you work your problems out, but it's very important for you to grasp what's going on mathematically before you take on some more difficult problems. So I believe they show some examples of how they came to the conclusions that they came to in the table. So again, there's actually two methods that you can use. Either method, you'll notice there's a huge or there. Either method will result in the same answer. Okay, so you can either, like I said, you can either take the weighted average of each stock's expected returns, which is finding the expected return for ZIG, multiplying it by the weight, which in this case, since it's a 50-50 portfolio, the weight would be 0.5. And then you would find the expected return for ZAG, multiply it by the weight in ZAG, which would be 0.5. And then you would sum them up, and that would be the expected return for the portfolio. Or you can find the expected return of the portfolio's conditional returns, which is when we look at the economic states. So you can also work your way all the way across for an economic state, like if you wanted to work your way across the row instead of down a column. And that would be the sum of all economic states for a given portfolio return in that state. That one's a little more complicated, but results in the same answer. I think just personally, my preference is to find the expected return per company and then add up the weights of that, or add up the weights per company of the expected return. So basically, my preference is to use number one there, just because I think it's easier, but each are possible. Each can definitely be done by using your calculator. And there may be instances on your homework where you're asked to do it one way or the other, and you might not have a choice. But if you are given a choice, definitely choose number one. I think that's the one that makes the most sense logically. Kind of helps you keep things in retrospect, right? So they do show you an example, and you'll see what I mean. So when we look at the two examples here, it says first calculate the state-dependent returns for the portfolio, then calculate the portfolio's expected returns. So the weight in ZIG times the return of ZIG given a state, sorry about that, go away, plus the weight in ZAG times the expected return given a state of ZAG. And so you'll see how the math here gets a little complicated. For the second type, or for the second way to solve for this problem versus the first. You'll notice that the first example, so like if we look back up here to these, Number one is represented in two lines here. So number one is literally, I wish I could point at it. This software doesn't allow me to point like my other software. But if you're looking just at the top two lines of this slide, that is one. So the weight of ZIG times the expected return for ZIG. Oh, okay, well, the expected return for ZIG is, 15%, multiply that by 0.5. The expected return for ZAG is 15%, multiply that by 0.5, and boom, my answer is 15%. Or we can do it the harder way, which is finding the expected return of the portfolio's conditional returns. So that's basically finding the sum of all returns for a given economic state. That one gets a lot more complicated. It's actually a two-step process. So you have to find the full portfolio return given an economic boom, and you'll see the math represented there. So that would be taking, 0.5, multiplying it by 0.25 plus 0.5 times 0.05, because remember, the weights are always evenly, this is a 50-50 portfolio, so the weights are always going to be 50-50 for each company, right? So you're adding up the weights per company by the expected return given a specific economic state. So it's always going to be half and half, but the expected return for a boom for ZIG is 0.25. But however, the expected return for ZAG is only 0.05. Moving into the steady economic state, it's still going to be half and half, but the returns, again, are different. One is 0.17, the other one is 0.13. And so you have to take half of each, add them together. And then in that last part there of part A, you have the recession, again, half and half in terms of weight, but what we note is that our stocks respond differently in terms of expected returns. And so we have a 0.05 for ZIG and a 0.25 for ZAG. And ultimately, they still come out to be the same answers, right? So we have an expected portfolio return of 15% in each economic state, but we got there very, very differently. And then we're not done yet. So if we do the second method, we have one step further to go. We then have to return to our probabilities of those economic states and multiplying the probability of the economic state by the expected portfolio return in that economic state, because we've only calculated the second part of that equation. And so there's another column that says, okay, well, we think that the probability of having a boom is 20%. Well, we now know that the expected return given a boom economy is 15%, so we're going to multiply that 15 by 0.2. And then we think that the probability of a steady economy is going to be 50%, so we have to multiply that by the expected return given a steady economy. And then we also think that the probability of a recession is 30%, so we're going to have to multiply that by the expected return of a recession. And so when we do that, we get that given the probabilities that we can have an expected return of 3% in a boom, 7.5% in a steady economy, and 4.5% in a recession. And if we add all those up, that is, once again, 15%. Again, these numbers are very easy. They all kind of come to the same answer. And I don't know if that's helpful or if that's confusing, because you're like, well, hold on, all the answers are 15. Sometimes it's better to actually have more realistic numbers, because then you can really see the differences. But one thing I do want you to note, if you don't note anything else, is the expected returns for each of these stock, given those economic states, are very opposite of one another, right? So if I scroll back up here, if we look at the return for ZIG and the return for ZAG in a boom, they're very, very different, aren't they? One is 25%, while the other is only 5%. Then in a steady economic rise, they start to level off, right? Like ZIG has a higher return, but not such a significantly higher return. And then suddenly in a recession, ZIG really slopes off, right? It slopes off. It kind of follows the stock market. But what does ZAG do? Well, ZAG's expected return is 25% in a recession. What does that tell me? It tells me that when the stock market is plummeting, ZAG is rising. And that means that ZAG is negatively correlated to the stock market, right? And ZIG is positively correlated to the stock market. And if you're not familiar with those terms, all it means is when you're negatively correlated, you go in the opposite direction as everything else. When you're positively correlated, you go in the same direction as everything else, right? And so what does that mean when, like, if we come back to that bird's eye view of diversification, that means that we have a really, really neatly set up portfolio. Go figure, that's exactly the example they wanted you to see, is that these two stocks level each other out. So while in a boom, if I only had all my money in ZIG and none of my money in ZAG, well, I would end up with a 25% return. However, in a recession, I would only get a 5% return. But by combining them together, I guarantee myself a 15% return no matter what economic state I'm in, right? So I think that's like an easy concept to grasp, but it goes a step further when we diversify. So the return aspect seems very simple and easy to grasp, right? Because you're like, well, that's pretty obvious. So, one is riskier than the other in a given state, while the other is riskier in the other given state, and by putting them together, they balance the expected returns out regardless of what state we're in. But we're not done yet. So let's scroll down a little bit further. So what we haven't talked about yet is risk. So I think it's easy and logical for a finance student to understand that by sticking two stocks together that are negatively correlated, I'm going to guarantee myself a moderate return regardless of which state I'm in. But we haven't really addressed the risk aspect of this. So if we were to calculate the variance, recall that the formula for that is the sum, okay? Remember, epsilon is the sum of, all right? So the sum of the return in a given state minus the expected return for the portfolio, and then you square that difference, and then you multiply it by the probability of that same state. Remember, state subscript I just means a given state, whether that be a boom, a recession, or a steady incline, all right? So if we go forward with this same problem, we can say, and this is where the numbers work out so perfectly, you can tell that the publishers really made this one up, but I mean, it does prove a point. So we can say, okay, in a given state, which I believe our first state was a boom, so in an economic boom, my expected return is 15%. My expected return for my whole portfolio is also 15%. So 15 minus 15 would obviously be 0. And then if you square 0, you get 0. So that's the first part. It doesn't matter what probability there is, because there is the answer would be 0 either way. And you'll notice that this happens every single time in this equation. So the return that is expected in a steady incline is 15%, but the expected return to the whole portfolio is also 15%. So if we square it, that's 0. It doesn't matter about the probability of that state, because that zeroes itself out. And the same thing happens in the final economic state, which is the recession. And so what we get here is we get a variance of 0. And so if we take the square root of the variance, we find the standard deviation, which the square root of 0 is 0. Okay? And so what you suddenly see is that while there is a considerable amount of risk if we invest in either stock singularly, when we put these two stocks together, when we match them up, because we chose them purposefully, we actually eliminate risk. Isn't that neat? Like this equation tells me that there is 0 risk in the portfolio that I've put together, which means that I can expect with almost near 100% certainty that I'm going to get a 15% return on this investment. While I may not get that 25% return that's associated with each stock separately in separate economic states, I'm also guaranteeing that I'm not going to get that low 5% return because I've put them together. And by putting them together, I'm guaranteeing myself a 15% return over the long term. Okay? So this is when diversification works. You must combine stocks that are not perfectly positively correlated with one another, because a perfect positive correlation means that they each respond the same exact way to whatever's going on in the economy. And we don't want that. We want them to respond negatively. We want them to respond inversely, oppositely. You can use any term you want. We want them to respond in a very, very different way. And so what we seek out when we diversify a portfolio is negative correlation between stocks, because this reduces risk and it allows you to achieve an exact return without having any risk involved at all. And that's what we want, right? So like if we look at it from that bird's eye view, what we can then look back to our investors and say is like, well, hey, we can guarantee you that you are going to get this return based on what we have done for you, which is invested your money in a number of stocks to where whatever happens in the economy, we can guarantee this exact return. It's not the highest return out there. It's not the lowest return out there, but it's a return that we can guarantee. So this is just some examples of, like, some visual examples of diversification. Figure 8.7 shows a perfectly positive correlation of two assets. So what you see here is you see the returns of company Pete, and then, this is so funny, and then the returns of company Repeat. They're really funny there, right? Like, I love the pun. And the returns of the portfolio, and what you see is they are identical. You might look at this as a beginner finance student and you might say, what in the world? Why are they showing me the same graph 3 times? Well, what they're wanting you to see is that if I choose two companies that respond to market conditions the exact same way, so those first two charts there, then the expectation would be that my portfolio as a whole would also respond that way. And so these stocks are perfectly positively correlated, and that's not what we want. We don't want our portfolio to respond so drastically to changes in the market. That is not at all what we want, okay? We want it to look more like this. So this is when diversification actually works. So these are two stocks that are perfectly negatively correlated, right? So we have the returns of ZIG and the returns of ZAG. And you'll notice in the first graph, when ZIG drops, if you look at the second graph, ZAG rises. And then the next step, when ZIG rises, suddenly ZAG drops. You see what's going on here? These are at the same points in time, and these are the same responses to different economic states, okay? And so I believe that ZIG was positively correlated with the market. So what we can look at here, like if we look back at our data, when ZIG, if we look at the return for ZIG in a boom, it would rise with the boom and it would fall with the recession. So we know that ZIG is positively correlated to the stock market as a whole. And then remember, if we look back at ZAG, ZAG was negatively correlated to the stock market as a whole. And so what we can deduce is that in our first graph, when ZIG falls, the stock market is falling, but ZAG is rising. It's negatively correlated. It rises as the stock market falls. And then vice versa, when the stock market rises, ZIG falls. And so if we put those two companies together, what it yields is the third graph, which is a steady return over time. You see that the return line for our portfolio doesn't move. So it's not that the economy is not changing in that third graph. It is changing. It's changing exactly the way that you see it in the first graph. But what's happening is by putting these companies together, our return stays the same regardless of market movements. And that's the goal. That is the visual goal. Okay? So let's move on. I believe this is redundant here. Okay, I see what they're doing. All right, so this is not perfect positive correlation, but this is positive correlation. So what we see here is that in this case, Pete drastically follows the stock market while ZIG only slightly follows it. So they're still positively correlated because they move in the same direction, but they don't respond as drastically. And so what we would still expect is that the returns of our portfolio would still flow the same direction, but the expected return would be some in between, right? Some average of the two returns. So you'll notice that the returns of Pete Company are significant when the stock market falls and rises, whereas the returns of ZIG are only slightly or more moderate. So you'll see that the arrow doesn't go quite so far below the x-axis. It also doesn't go so drastically above the x-axis. And then the return of our portfolio is kind of like an in-between. It's like that middle ground between the two examples that we see to the left. So that's what this example is showing you. Okay, so what we see here is a true benefit. And I like this example. This is the last slide for this short lecture component. But what we see here is a more realistic example than our zig and zag example, because this looks more like stocks that we would see. So you'll notice that Pete is a less risky stock, and it's very obvious that Pete is less risky. If you look at our chart down in figure 8.1, we'll see that Pete has less return, but it also has less risk. We'll see that Zag has a higher return, but also higher risk. We have our table 8.5 that shows our expected returns given certain economic states. When we start looking at this table, what we notice is that both of those stocks are positively correlated, right? And how do we know that? Well, the return of Zig is 40% in a boom. The return of Pete is 22% in a boom. So they're both kind of in the same area. Zig's just a little more, a little higher than Pete, but we know why. It's because of the risk associated with them, right? But what we see as we look at the steady economic state is that they both fell. Zig fell significantly more than Pete, right? And so they are moving in the same direction, but Zig seems to respond to market changes much more drastically than Pete. And we can guarantee that we know that with certainty, because then we look at the recession and it again responds more drastically. It's a drop of 17%, whereas with Pete, it's only, well, actually Pete drops 19%. Shame on you publishers, it shouldn't have been that drastic. If we wanted it to really prove the example, it should have been a little less drastic. I guess somebody didn't do their math is what happened. They think -5 and -4 is enough, but blah, 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 I'm rambling. But the point is that these are positively correlated stock, and we are given a few different measures. So the expected return overall for Zig is 12.5%. The expected return overall for Pete is only 10.7%. And then we see that the standard deviation has already been calculated for us. So though I have a higher return expectation for Zig, there's also a higher standard deviation. Remember, standard deviation is a measure of total risk. And so one standard deviation for Zig is 15.6%, which means that my range, I have like, what is that? That's like, 2 down, 1 up. That's a 31.2% standard deviation range for that 68% confidence interval, which means there's a wide range of variability in what I can expect for returns with Zig. Whereas with Pete, my expected return is lower, but my standard deviation is lower. My return's only 10.7%, but that standard deviation range is only 20, right? Because if we take 10 and we multiply it by 2, that's 20%. And so there's only a 20% range that Pete can fall into, okay? And we can take this a step further. So we can look at the expected return overall for the portfolio, and just like in the example above, we see that there is a moderate return. So while I won't, like when I put these two stock together, while I won't get that 12.5% return, like if I evenly weight, like I do a 50-50 portfolio, which is what is stated there. If I evenly weight my portfolio in both stock, I won't necessarily get that 12.5% return, but I also won't get the 10.7% return. What I get is an 11.6% return, which is a good middle ground between the two. But here's the other piece of the puzzle that I want you to see. Look at the standard deviation. When I put 50% of my portfolio in Zig and 50% of my portfolio in Pete, I also find a moderate ground for risk. Isn't that interesting, right? So my risk is almost eliminated away in a sense. I'm suddenly not having such a wide variance on Zig or a significantly low variance on Pete. I have this middle ground again. And that's what the chart in the lower right-hand corner is showing you. So not only does the expected return rise, but the risk finds that middle ground. It lowers, okay? And that's a very important thing to note because it tells us what a well-diversified portfolio is able to do. We are able to eliminate unsystematic risk, okay? And I believe that's what our next slide starts to talk about. So adding more stocks to the portfolio lowers and lowers and lowers our unsystematic risk. And you'll recall that there's two types of risk. There's systematic, which is macroeconomic risk. It's when big events happen, it affects all stocks in a market. And then there's unsystematic risk, which is risk associated with an individual company. And the more and more stocks that we add to our portfolio, the more and more that we eliminate unsystematic risk. The chances that a company, having something crazy happen that is specific to that company would hurt our overall portfolio return. And so, like I said earlier in the lecture, the closer we get to 25, the less and less unsystematic risk that we have. It actually is almost 100% eliminated away. All right. And so that is the end of this lecture. Just recall that we did talk about this, that there are two types of risk and that standard deviation measures all of them. I have also mentioned to you that the second part of this chapter talks about looking at one specific type of risk, which is beta. We haven't gotten there yet, but that's going to be what the next video is about. But just to sum up everything that we've done so far in this chapter, we have learned how to measure the expected return for stocks, the expected return for a portfolio, the expected standard deviation or total risk, because remember, standard deviation represents total risk for a given stock, as well as the expected total risk or standard deviation of a portfolio. And looking at some examples, we have found that unsystematic risk, or risk that is associated with a particular company, is diversifiable risk, which means it can be eliminated. Risk that is associated with macroeconomic elements is referred to as unsystematic risk and is not diversifiable. All right, it's considered market risk. And so like when we hear that the market is in a recession or in a boom, that is systematic risk, and it's something that we can't diversify away. And so when we say that someone does or does not have a well-diversified portfolio, what we mean is that is someone who has unsystematic risk that has been completely eliminated. Okay? And a perfect example of this in the real world is large mutual fund companies. And remember, we've talked about mutual funds. That is where you have a fund manager whose sole purpose is to take your money and eliminate risk by giving you an expected return that they can guarantee year over year. All right, well, that's all for this lecture. Look for more videos coming up soon. Hope you're having a great weekend. Talk to you soon.